Are you afraid to risk your hard-earned money in binary options? Well, BinaryOptionsCashback.com give you an ability to invest your money without the risk of the initial deposit. How does it function? Would you like to invest in binary options, but it scares you to think that you could lose your money? 1. Select any broker from our selected web banners. 2. Open an account and deposit the recommended amount. 3. Send us an email to webmaster@binaryoptionscashback.com with the following details: name, broker's name, deposited amount, and the desired method to receive your money back, i.e. PayPal, money brokers, or bank account. And within a short duration of 30 days, you will get the return of the deposit. This advertisement comes with no obligations. We don't require any minimum amount of trades, and you can withdraw your deposit whenever you want. On the other hand, you can open an account with any or all brokers listed and receive a consequent refund.
Hello class, this is Brian from FinancialTradingSchool.com and welcome to BO 104, Break-Even Ratios. So the break-even ratio is very crucial in how you trade binary options because this isn't a zero-sum game. As I explained in the introduction video, BO 101, binary options is a derivative instrument, and for most cases, derivative instruments are not zero-sum games. A zero-sum game is basically where you have buyers and are equal to sellers, like in stocks. Because you're buying a stock, there's going to be a seller on the other end, or if you're selling a stock, there's a buyer on the other end, so it always equals up and it ends up being zero in the end. But here with binary options, since it's a derivative instrument, there's not necessarily a trader on the other side of the equation, and you're usually trading against a broker. So in that sense, it's not a zero-sum game, so it doesn't always add up to zero. That's why you have to be careful when you trade these. That's why you need to win a certain number of trades in order to profit, due to the nature of fixed payouts and fixed trades, because you know how much you're going to lose up front, that's your trade amount, and you know how much you're going to win, that's your payout. And based on these numbers, you can calculate using probability theory how much you need to break even, because once you know how many trades you need to break even, then you can determine how many trades you need to win higher than this ratio to profit, or lower than this ratio to lose. And you're trying to get that amount of win ratio up to a certain point such that you don't lose any money and you're making money, but high enough to make money and not just to break even. So for these calculations, the acronyms is ITM percent, which is in the money percent payout, which is how much you get when you win the trade, and OTM percent, which is out the money percent loss, which is how much they take. So I'm gonna use Paint to show an example, the proof of this. Then once I figure out the formula, which we will arrive at after the proof, I'll show an actual example with the numbers, and then I'll use that same formula in Excel spreadsheet to show this formula in place and see them in action. Then I'll tweak the numbers above and below the break-even ratios to show you that there will be a profit if it's above. At the break-even, it's going to be $0, so that's break-even, and then below it's going to be a loss. Afterwards, I will upload this spreadsheet with the break-even formulas and put a link in the description so you can play around in the spreadsheet yourself, just to see what you need to make enough money for your goals, to see what you want. So I'm gonna get started on that now. So let's switch to Paint. So I'm just gonna try something new for this episode. I'm gonna actually attempt to write out the stuff in Paint using a tablet, and we'll see how it goes. So the first thing we need to calculate the break-even ratio is probability theory first. So in probability, in this case, we're going to have A plus B is equal to 1. Because basically we have two events, and the probability of them both occurring have to add up to 1. Assuming that there are no other uncertainties in this equation, which in our case there isn't. So it's just either you win something at some percentage, or you lose something at some percentage. So that's the probability theory. Then we have the generic formula, which we'll be using is the in the money percent, which is multiplied by the number of trades that you win, A, subtracting the out of the money percentage multiplied by B has to equal to 0. And it's equal to 0 because we want to find the break-even ratio. So now, if we rearrange this probability formula to give us B is equal to 1 minus A, this B can be substituted into that B in the beside the out of the money percentage. Thus, this gives us an equation that only contains A. And then once we have this, we can solve for A. And you get that. So that's subbing in the 1 minus A into the B term. And now the next step is we need to solve for A. So we have the in the money percent A minus out of the money percent. Kind of hard to write. This is a plus because double negative. Out of the money percent A equals to 0. So now we want to solve for A. So we move this out of the money to the other side, right? Negative. Once you move it to the other side, becomes positive. Then you collect the A terms. I'm not going to do that step. So basically, in the end, you have A is equal to out of the money percentage, right? Because this is on the other side, divided by the addition of the in the money percentage plus the out of the money percentage. Kind of hard to write, but that's basically the formula that we'll be using, and you can apply this to any formula, any numbers you want. You can try this right now on your calculator, or you can wait for me to go through the example. But basically, the number of trades, A, that you need to win to break even is the out of the money percentage, which is how much they take. So most brokers take 100%, which means they pay out 0 if you lose. Or some might take 95%, in which case you get 5% back. But most take 100%. So you go 100% divided by the into money percent, might be 70%, 80% or something. I'm going to use 70% for my example. 70% in the money, 100% out of the money, or 0% payout for out of the money. So for that equation, it would be 100 over 70 plus 100, which is 100 over 170, and that gives you about 58.8%. So now just show the math for fun. So like I mentioned, we're going to use in the money equals 70% and out of the money equals 100%, which is how much they take. If you were to go through the math using from the very beginning, you would have 70% times A minus 100% times B equals 0. And then from before, B is 1 minus A, right? It doesn't matter what numbers you use, because in the previous proof I just used the letters, and letters you can replace with any number you want. But I'll just go through this again for those of you that don't believe me. So subbing in the B term into that B right there, you're left with 70% times A times 100% times 1 minus A equals 0. Then once you're left with all the A terms, you're collecting it again. And then once you get that, you're moving